at some point we're going to be allowed back open to a varying degree. So market opens again. What does everyone think prices are going to do? Obviously, it's just like saying, what price do you think Bitcoin's going to be in 2 weeks' time? I don't know. No one knows. But what is the general consensus of this group? Rightio, we are recording. It's 1500. Let's crack on. So, welcome to the property investing debate, the good, the bad, the ugly, the oblivious, etc. This is recorded if you're just joining, so I wouldn't worry. Now, before we get into the open floor, so to speak, I just thought I'd some of you would have heard a lot or some of my stance, etc. But I thought we would basically just start from scratch, and I'm just going to share a screen. And the thing is, just realised my camera's not on. Sorry, I did. Not that you want to see me. I look dreadful. Trying to develop my silly little beard. Anyway, let's stop that. So, right. Now, as you know, I'm a big fan of first principle thinking. Good old Aristotle. And I do this with everything. From big picture stuff down to stupid stuff. Like, I was making a marble run for my kids a few weekends ago, and I was trying to look at first principles to think, all right, what is the best way to create this marble run? You have to trade height sparingly so you can have a longer run and all that sort of stuff. And when we look at property, you can't just go straight into property, which I think so many people do. And ultimately, we are all in the wealth generation game. And good old Mike Maloney said something similar to this. If you know the game and the rules of the game, you have a fighting chance. But if you don't know the game or the rules, you're going to get slaughtered. And there are many different games, and there are games within games. And I think there's quite a few property people here. Property is not just one little thing. It's one huge thing with multiple silos. Much like trading. Trading has options, futures, spread betting. There's all sorts of things. So, you basically, in my view, when I'm looking at a big picture thing, you have a player and a spectator. This is the wealth generation game, by the way. Now, obviously, you're going to have a shade of grey in between, but effectively, you can put everyone into the player category or the spectator category. So what is the game? The game is to reach level 1 or 2, whichever you fancy, as quick as you can. Now, level 1 is financial independence, and level 2 is financial freedom. Or there's a cheeky secret level, which not many people explore, and that is financial abundance. So here in the WAP planner, I made this years ago, this is, again, in my opinion, what I deemed was a route which some people could aspire to. Obviously, they may not do it in order, but when I look at it, you're financially covered when your residual income totally covers your existing essentials. You're financially independent when your residual income totally covers your existing expenses and liabilities. This is just a little snazzy spreadsheet which totes it all up for you. Then you're so these two, you don't necessarily do them in order. You could just completely leapfrog them. But I call financially buffered when you have 3 months worth of essentials in cash or assets, i.e. liquid stuff. And when I say buffered or essentials, that is your operating costs, as in your essentials here is basically everything you need to operate, to go out, work, derive income, etc. Then you're financially safe when you have a year's worth. Pretty straightforward. And then you're financially free when you can literally go and do whatever the hell you want. Boats and hoes, yep, go for it, whatever you want. Sorry, it's probably not politically correct, but I'm not PC. In fact, I hate PC people. They can piss off for all I care. So yeah, so financially free, this column, this is literally where you could be as silly as you want. You know, if you want to walk around with 500 quid in cash at all times in every pocket, go for it. If you want to go out and buy a private jet, whatever. Everyone has different shades or degrees of financial freedom. So, I mean, some people may not ever want more than $3,000 a month or £5,000 a month or whatever, whereas some people would want 5 million a year, or But then the cheeky secret level, which not many people explore, is financial abundance. This is really where I guess you get into the, where money is just ridiculous, where the interest or ROI you're getting every year completely outweighs everything you spend, even if you're being a douchebag, buying jets and cars and yachts, etc. But the cool thing, or not the cool thing, but what I really deem, like, if you get here, I think you have a moral obligation to do, to basically, you have the power and the means to create or make meaningfully positive difference to the environment and mankind. So, however, a lot of people don't do that. So that's just a quick rundown of what I personally see as, some of the levels. But really, there's level 1 and level 2. How? Well, basically, don't break the law. And use any assets or activities that you see fit, and basically don't be a dick. So I think that's a pretty simple game. We all play. We are basically forced into it at birth, and I guess at any point in your life you can choose to oscillate between the two. You can either be a spectator and then go, actually I want to have a go at this, or you can be a player and then not. You can be a bad player. Being in this side doesn't mean you're good. You could give it a go and then go, shit, this is not for me, I'm just going to become a spectator. So, where does that lead us to? It leads us over here, spectator. So, again, this is just my opinion of how I see things. So, the spectator, typically, I'm being big, broad brush here, not interested, thus can't be asked. And if you're not interested in something, you're not going to expend the time, energy, and money to really try and figure things out. Most of the time, spectators, I have found, I guess probably a good 80% of spectators have negative mental associations with money. A lot of people I see in the spectator group, they think money is evil, the love of money is evil, blah blah blah, whatever. So I guess if you're a spectator and I guess it really hinges on this bit. If you're not interested and you can't be asked, then fine. I mean, there's no right or wrong. You don't have to play the game. So if you are a spectator, you may as well stick to the conventional route in order to maybe, I need to basically underline this 1 second. Maybe be safe at retirement, because 50-year-old advice, which was once wise, is now not exactly wise. So what is the conventional route? I guess pensions, all forms, employment pensions, all that sort of stuff. ISAs, cash ISAs, stock and shares, trackers, rainy day fund, i.e., or when I say rainy day fund, really, that's basically being financially buffered or safe. So again, what you see that as, live within your means. This is a particularly hard one. So this is why the spectators end up in financial trouble, because they can't live within their means. I personally hate that term, live within your means. I think it's bullshit. I want to live beyond my means, and therefore, because I like living beyond my means, I have to increase my means, and to the point where I need to increase my means to the point where it's no longer an issue. So I don't like. I'm the reason I play the game is because I like nice things, and I'm not ashamed about that. I have no qualms about wanting and having aspirations to want more. People are different, which is why I guess I'm like Marmite. So yeah, I guess if you're a spectator, you may as well buy a house and don't move often, because if you look at obviously all all mortgages are different, but if you were to get the average mortgage and you were to pay it off, it looks like this. Let's say you've got 30 odd years over here, and what you'll find, actuaries, they've found, it's not like a discovery, they just know this over a long period of time. Obviously this is the worst drawn graph ever, but most people tend to move house after about, I think the average is 7 years, and so this is why when you look at the principal payment graph, like, you don't really start paying off a big chunk of your capital until after sort of year 9, because the moment you move house or you remortgage or move house, the bank has got you. the lender knows this, and they know that, right, yep, everyone has the itch, the house itch after every 7 years or so, and so that's why, you know, banks love it. And for those, again, who are not familiar, big broad brush, if you've got like the average house, let's just say it's, I don't know, 200 grand mortgage, over 30 years, the bank will make roughly 160 to 200 grand over a 30-year period, roughly. Ballpark. So why do you think lenders and banks love giving out mortgages? Because they know once someone's got a mortgage, they're stuck for life. Hence the old more gauge, you know, the French more is to die or death, and gauge is a measurement. So that's, I'm trying to speed through this so we can get to the open floor. So that's, I guess, the spectator. So then that leads us all the way over here, and where I got interrupted with kid stuff and I couldn't complete the player bit. So I guess we can do that ourselves. So is everyone with me so far? Yeah? Some people probably disagree, but yeah, whatever. Now, if you're playing the game, I guess there's two parts of it, obviously. You have, again, this is my sort of... oh dear Lord. That's supposed to be a hat, by the way. So this is my opinion hat. But I believe if you're a player and you're playing this wealth generation game, I guess you have two phases. Some of you have seen something similar like this. But you have your aggressive... wealth... oh, well, TH... accumulation phase, and then you have your capital preservation phase. Pretty simple, right? And again, my belief is that you cross over into this bit when you hit financial independence. When you're financially independent, you can do whatever you want because you've won. You've reached level 1, which is, you know, you win. And then obviously, so in your so this, as you can see in this opinion piece, this has no inkling or your age has zero relevance. So a lot of IFAs will go, oh, okay, you're 50 years old, so you need to do this, or you're 20 years old, so you need to do this. Well, in this, again, opinion, your age is irrelevant. I mean, there's so many people that become billionaires when they started, you know, in their 60s. So, I mean, it's never too late. Oh, I say so many. There's been several. Or lots, I guess. So, obviously, we're going to sort of ignore this phase over here because there's all sorts of things you can park your money in. But I guess the object of this, I guess property is over here as well, to varying degrees. But you then have your cash flowing, and then your capital appreciating. I'm just trying to speed this up. So obviously, capital appreciating stuff is, you know, hope you buy low and then hope you sell high. Sorry. Yeah, buy low, sell high. I always get that wrong in real life as well. And then obviously I mean, there's loads: Bitcoin, houses, stocks, properties, wine, sports cars, you know, whatever you want. Cash flowing is a bit different, and we can actually draw the list of cash flowing assets because it's very, very small. So we have business, we have debt, as in you could lend. What other cash flowing assets? Divvies from stocks, but they are so insignificant. It's ridiculous. Like if you want to live off your divvies from from your public stock, you need a lot. Divvies. What else is there? There's cash flowing. I was going to say inheritance and lottery, but that's just luck. You shouldn't. That's like, you know.
There's the obvious property.
That's business though. So yeah, this is where I'm coming in here. So I guess, obviously, we'll go into the open floor in a sec. So see, this is what I'm trying to lead up to. Property is a big can of worms. So, as I said, for spectators who are just going to buy a house and just live in it, or one, it's their home, so they're really not looking at it as an investment. But I guess a lot of spectators do. So they're really hoping to hell that their house will, double in price every 10 years or whatever it may be. But remember, in the cash flowing bit, if you're doing any form of property stuff for cash flow, you're actually in a business. It is a business, and property are your widgets. It's the things that you sell or that you offer. Just like if I buy stuff from China and sell it on Facebook or whatever, it's the same thing. So I guess that is my intro. So then this bit we can do together. So I wrote a couple of notes. So now we're getting firmly into property in terms of cash flowing or property investing. It's basically what silos do you have. So if we go over here, we have buy to let, we have commercial buy to let. I'm probably not spacing this out correctly. You've got development from scratch, or from whatever stage. Flipping. What else do we have? We have rent to rent. We have lease. Oh my lord, I'm not spacing this out at all. We have lease option to let. I'm sure there's a better name for it, but that's what I call it. And then I guess there's deal sourcing. Are there any silos I've missed out that are cash flowing silos in property?
Put serviced accommodation down there.
Is that rent to rent pretty much though?
Not necessarily, but
so let's do that anyway. Let's move this along.
Tends to be higher yielding.
Surely isn't serviced accommodation just a fancier version of buy to let?
Yeah.
Let's just 1 second. It's basically buy to let with a spin.
Buy-to-let can be divided into a lot of different categories.
Okay, so let's just quickly explore that. So once we've mapped out, I guess what we're doing is we're mapping out the board game in the property, just like Monopoly. We're now mapping out, So in buy to let, I guess service accommodation, this does not really come out. Okay, let's just write this. So serviced accommodation. What else is there in the buy to let silo?
Assisted living.
Sorry?
Assisted living.
Assisted living, yeah, that's a good one.
Put HMOs in there.
Student lets, HMOs.
Yeah. So student lets, HMOs. Well, I guess you do an HMO to do a student let, or
A slightly different student lets tend to fall into a different category, but say they are similar.
Yeah. Okay, HMOs. What else in this silo? I think that's pretty much it, isn't it?
Basically, yeah.
Yeah.
Traditional renting as well.
Traditional renting.
Yeah.
You've also got holiday lets as well.
So, sorry, Hadley, can you just expand on when you say traditional?
Where you just rent to a family house, like a 2-bedroom terraced house.
A single let.
Single lets.
Yeah. Cool. So it's pretty much that silo. We can space. In fact, what I'll do, get my mouse out. Oh dear. I'm pretty sure once we mapped all this out, someone can make it nice and pretty. Right, so let's This is painful. And I apologise for all the experienced property people here. This is probably teaching you to suck eggs at the moment, but I'm pretty sure for those people that have no idea about property, this has already highlighted shitloads of things that they probably weren't aware of. Okay, so before we jump in, deal sourcing. What are the... So when it comes to deal sourcing, what, I guess, little tiny minutiae is there?
There'll be deal sourcing just is a header to all those other categories.
Yeah.
So you could tell us what,
It's like
any
lead
of
gen,
those
basically,
buy to
yeah.
let. Yeah, it's lead gen, yeah.
Yeah, let's just leave it as that. So it's lead gen, and then it's an arbitrage there. You're getting a lead, getting profit from it.
Crucially, it is different because obviously you're not holding assets. So
Yeah,
really, it's just the business bit of it.
yeah. So, okay, lease options to let. I guess it's just another mechanism to get to do buy to let, really. Would you agree or
Yeah.
disagree, people?
Yeah, without holding the risk.
Yeah. So I guess actually it's probably better if we just move, because obviously buy to let, some people choose to buy it, some people don't really want to buy it, so they can just do a lease option. So let's put that there. Okay, commercial buy to let. What do we have there?
Buy as an investment and then buy as a business. It'd be different.
Could you explain that a bit more? Sorry.
So you could buy a trading business that owns.
Oh yeah, buy the company. Yeah.
Yeah. And then the other one would be investment buy, where you wouldn't touch the trade. You'd be a landlord for the trading business.
Yeah. So buy. I guess. So I just put invest in. Commercial. I guess you then have. I guess sort of. I'm sure, as you know, I'm not a property person. So off. Off plan. Biz invest. So what? So for example, let's say I wanted to buy shitloads of land to build a massive care home of some sort, and in order to offset my risk, I wanted to sell rooms of that care home, and people could buy literally. I know the care home was going to have 100 rooms, and you can buy a room, and then you would get all of the yield of that room, or a percentage of that yield. What would you say that is called?
That is either a real estate investment trust, better word,
Yeah, actually, yeah, a REIT.
or it's sort of it's almost like off-plan development sites where you just buy the site, sell the site to self-builders almost.
I think it's got a lot of moving
It's
parts
another
there.
way of crowdfunding it, really, isn't it? That's really what it is.
Commercial version of buying off plan, basically.
Yeah.
Yeah.
Okay. Yeah, I'll just leave it as off-plan biz invest. You can do all sorts of different things like that. Like one guy I know has bought big plot of land, and he's turning it into burial grounds in the London area for a certain religious type. I can't remember, but it's a certain religion that they have to bury, not cremate. And so yeah, he's selling plots of the land, and it's basically burial plots. There's all sorts of different things like that. Okay, so that's that. Okay, development. I guess a lot of these really tie in, don't they? Like development really comes in with with the off-plan stuff and all of this. But are
They
there?
could also fall into traditional buy-to-lets and just normal purchases as well.
Yeah,
Both.
exactly. Yeah, so we can actually. So let's do a little cross thingy-majiggy here. So all all of that, and then I guess all of this. Oh, I made that really rough, but you get the gist. Are there any specific things in the development world which don't sort of step on all of these toes?
So the only thing that doesn't, the lease option thing is probably direct lease option is probably much more prevalent in development than it is in general property. That would be the way that the large and a strategic land actually is the other one that wouldn't come into it.
So can you elaborate strategic land?
Yeah, so strategic land would be basically what people, when they're trying to be mean, call land banking.
Okay.
Holding land to try and get it reallocated as developable land.
Yeah.
So it might be something in the green belt that in the next 10 years, because it's next to a large settlement, will be within the settlement boundary, or you could rightly argue that it ought to be rather than building elsewhere.
Yeah.
Strategic.
God, that's proper long term, that land bank, yeah.
That's mega. Yeah, I've got clients with 25-year options.
Jeez.
That's why it's really rude to call it land banking. You know, it's like, oh, well, they just buy it and the price goes up. It's like, no, it doesn't. It's taken them 15 years worth of work.
Yeah.
It's a bit rude.
Okay, so now we're in Kevin's world here. Flipping. So I guess you are, with a flip, you're simply buying a house, adding value, and looking for an arbitrage. Or, okay, so let's say let's just do add value, arb. Then there's planning arb. So Kevin basically buys dirty, smelly, ugly houses, makes them pretty, not smelly, and then sells them. That's what you do, Kevin, right? I guess. Yeah, pretty simple. Another thing which one of my mentors used to do is he got an old town planner who knew the game, and basically directed the town planner to hunt for properties which he knew that he could guarantee get planning approval or some sort of planning. I think what he was doing was buying big old empty trampoline parks or disused nightclubs, and this planner would try and see if they could be converted into flats or other bits and bobs. So, and then the moment planning was approved, he would then flip the whole thing. So he didn't want to go through the ball ache of actually going through and doing the building and all of that. So
yeah, that's called trading. I would put that under the development route, because
okay,
anything to do with planning uplift that's what developers do basically.
Okay, cool.
You can also do that on single properties with large plots of land. So you buy a 3-bedroom bungalow with 2 acres of land, get planning on it for 3 or 4 houses, bash a bungalow down, and then whack 3 or 4 houses up. So that's
That'll be the
development.
Okay. Is there anything else in the flipping world? Is that pretty much it?
Arbitrage without adding value. That's a bit more prevalent in America than it is in the UK.
Yeah. Okay. And then rent to rent. Okay, there's a few different things here, isn't there?
I would say that's just a strategy that sits on top of the buy-to-let one.
Yes, actually, that's a good point. So,
because in anything else, it's a lease option.
See. Oh my lord! Come on. There we go. Yes. So, I guess something like that. Right. So this is property. Okay. So let's backtrack. Lars, I heard an uncomfortable groan from Lars when I said property is a business. Could you elaborate on that?
Nothing to say really. It's I wouldn't say it's a get out of jail card, but it's more a when saying that property is not a way of gaining financial freedom, and then just brushing it over by saying, "Oh, but it's business." Well, it is the property that is creating the wealth. You treat it as a business. That's just you're being professional about it. So for me, that's just my viewpoint. Is that yes, if I trade properly, that's also business.
Yeah.
So, but it's still the trading that creates the wealth.
I completely agree. I think we agree on the same thing. I may have just misworded it, but yeah, you can become financially independent through property.
Yep.
I do agree with that. I think it's just a definition thing here. So,
Siam?
hello.
Hello, Justin. The only thing I do say about property is you need to separate out residence from investing. I've always said that if it's a residential home, you're not buying it for an investment. Yes, you may ultimately make money out of the property, but you're not buying it specifically to invest. If you're buying properties to rent out, develop, flip, whatever the case is, that's looked at very differently. The only reason I take that stance is if I buy a property as for myself and my family, I'm not going to kick myself out in financial difficulty, whatever the case is. If you're renting a property, potentially, the landlord could sell the property from underneath you, whatever the case is. So when you talk about property as, you'd have to separate them down and say residential to residential, other stuff falls into the investment, which is what you've just kind of gone over there.
Yeah. Okay. So I guess where this leaves us right now, when we're looking at this whole thing, obviously we're not going to touch on anything else like trading or anything. We're just property. So I guess this is the property map. I guess now is the open floor, really. Like, what do you guys want to debate about? Because I think like the reason I wanted to really distinguish the whole thing is because I had a lot of personal backlash from this video here, and I think it's just completely out of context. That whole video or that LinkedIn article, which is the same thing really. I was literally just focused on spectators trying to jump into buy-to-lets because buy-to-lets looks like has done well over the last decade, etc. So yeah, I guess that was that.
Right, mate, as a mortgage broker, I mean, the way I approach it, as a mortgage broker, if somebody says to me I'm looking to buy a residential home,
Yep.
Is a very different conversation to I'm looking to invest into property. Now, obviously,
Yeah.
every deal I do, I get paid for, so it's in my interest to do that, but I do say to clients, if you took the name off of the investment and said, don't call it property, call it popcorn, is that popcorn going to give you 12% return where you can get 5% elsewhere or vice versa, then make a decision. So whether it is property, bullion, crypto, trading, what have you, becomes irrelevant. So two different conversations to be had there. Residential, different conversation. If it's investment, I always ask clients, unless you're an experienced landlord or you know what you're doing, there is a lot of money still to be made out of property if done correctly.
Yeah.
Where I get a bit nervous when somebody says, I'm buying a property to flip it, well, you need to know exactly what you're doing and probably have a buyer lined up. If you just buying it to organically make a bit of money out of it, it's like you need to know what you're doing. If if the property markets do go south, then you're going to be find yourself in difficulty. So it is a case of how long you're looking to hold on to it. What are your plans with it? Is it traditional buy-to-let? Is it HMO? Is it flipping? And then make your decisions from there. But there is a lot of people that contact me and say, want to get in buy-to-let. And I'm like, are you sure there's not other things that you could be doing with your money that may return better given the current climate? So yeah, it is a very open conversation. I think it is, you could debate this all day long.
Yeah, valid point. Okay, so I guess the next thing, in order for us to direct in our conversation a bit, is something like this. Let's just put in some random posts in the ground. Obviously this isn't to scale. Let's quickly extend this a bit more. Right, so now we know what vehicles we have. So, as in, when I say vehicles, each one of these is a vehicle, and just like different vehicles, some are like Ferraris and some are Fiestas. So, where would everyone position those vehicles? So let's start off this end. What is making less than 0% net yield at the moment, would you all say?
Residential home. Oil. That's in negative territory, isn't it?
Okay, so I heard a few people say. So what I heard. So what was said? Residential.
Residential. Because that's your home. It's not an investment.
Exactly. It's not an investment, so it shouldn't.
Yeah, it's not even on here.
Put into this class.
Yeah.
Yeah.
I would sort of I would gently challenge that. I mean, it
Okay.
could be used as a vehicle to increase your wealth, particularly as though there's private residence relief, which means you can make money tax free.
What would you say the yield is then, Joy?
I think it's a tricky one to gauge, and it does depend on what's going on with house prices. It's a tricky one to gauge. I'd maybe, so this is an annual table, isn't it? Surely it's got to be in line with inflation, I would argue, as a bare minimum.
But you haven't bought the property with the intention of renting out that room.
No, so I'm just talking about capital appreciation. Perhaps in
You can also
terms
lose
of...
money.
Yeah, but this here is. So, I guess this is. Yeah, we have. Do we include capital appreciating stuff in this chart?
Why not do a second one as to the capital and an argument on both sides as to
Because lots of them do flip.
property will go up and property will go down.
Yeah, you can. I don't think it's really fair, if I'm honest, because people will immediately. If you're going to talk about capital appreciation in your own home, you then have to talk about all the maintenance that you spend on your own home, all the financing costs, all the people.
Council tax, everything. Yeah.
Yeah, you.
Well, actually,
The
maybe not.
vast majority of people
Hmm.
immediately discount all of that when they say my home's gone up 50 grand, and you think, well, yeah, but you did a loft extension that was 30, and you did, so even stuff like that, you have to compare like for like if you're going to compare your own home.
Okay.
To an investment, you have to add all the costs in.
Yeah.
For now, I'm just going to sort of put home
Yeah.
somewhere around here. Okay.
Yeah.
Just so.
It's still an interesting one because interest rates have been at an all-time low, haven't they, for about 10, 12 years now.
Yeah.
So I think it's worth putting it down there. I think also down the bottom end we've got residential letting, haven't we? The single lets, that's low yield.
Okay, so let's look at single lets. What would everyone say is the net yield?
I'd say probably no more than 5%.
But we have again, is it yield we're looking at, or is it return on investment?
ROCE. That's really all that matters. Return on capital invested.
That could be infinite.
Yeah, good point. Yeah, actually.
Technically, you can let out investment
It
here.
depends on how you combine all the strategies that you put up on top there. That if you have done it on a purchase lease option,
Yep.
if you have bought it below market value, if you have added value, the list is infinite.
It's a very valid point.
Are we annualising this though? We're doing this on an annual, just so we've got some sort of basis to mark everything against.
I'm going to leave it to you guys. What do you think? I'm just the facilitator now.
Yeah, I mean, a single let is traditionally in the below 10% ROI. And if you go to the HMO market, you're traditionally around the 20%, but you can get them up. I have had HMOs, I have single lets that are infinite return.
True.
I think it'll be infinite return as long as you hold the prop and it's making some sort of profit, so technically it would. I think just coming from a mortgage broker standpoint, I'd say that your traditional buy-to-lets would yield less than if you went into multi-lets, HMOs, stuff like that. I mean, I've got clients that are paying 200 or 300 quid for a mortgage, and they're renting their property out for £2,500. Now, if you said to me, is property a bad investment at that point, I'd be saying you're silly, gobble up as many as you can. But there is obviously the flip side where, the numbers just don't work. So yeah, I'd say basic single lets are probably going to yield a hell of a lot less than your HMOs and your multi-lets, but then there's substantially more work involved and a lot more costs to set up and maintain.
Yeah.
Okay, so in fact, if you had like a chart, so if that was 0%, with anything, you're going to have the outliers. You're going to have stuff which, infinite percent. You're going to have stuff which, you're going to bomb. So when we're I guess we're just going to try and focus on this. Obviously, there are going to be the outliers, etc. So in order to move on, should we just say basic single lets around this sort of range? And would you say that's still valid even after section 24?
Yeah.
Yep.
Even after section 24?
Yeah, that's a good point.
No.
Depends on when you bought your property. So if you're saying buying it now, I'd probably say not.
Yeah.
If you're already a historic portfolio holder, then yes, you're going to be.
So starting from now.
Starting from now, I'd say probably 5-7% you're pushing it.
So shall I put it here?
Yeah, put it there. Yeah, that makes sense.
Yeah.
Okay, cool. Yeah, so there's so many caveats. Yeah, so we're starting now. Right, what's next? Let's do... Okay, so I just saw in the... Oh, I've completely ignored the group chat box. Sorry, for those without a microphone. I've just seen Gavin Braz. You can rent a room. So, sorry, that's a bit out of context. I'm not sure when you said that.
I think that would probably fall under the home, because you can do a rent room from home.
Ah, yes, true. Okay, yeah. So that net yield is going to be definitely in this place if you're renting out a room. Okay, so what else shall we look at? So I guess service accommodation. Obviously, that itself is, you could probably break that up into. But I mean, where would you put service accommodation then? People.
It's very similar to HMO, really.
20%.
Okay, so we have one over here. So I'll just write it out first. HMO, so serviced.
HMO's SA is around 20%.
Net.
What do you think? Yeah.
Yeah.
What? So even further along.
Yeah.
Like this.
Yeah.
Okay, cool. And just for
They can vary very wildly as well, depending on the bedroom's location, stuff like that. But I've got clients paying 200-300 quid for a mortgage, £2.5 rental income coming in. But I've got others that are a hell of a lot tighter than that.
nice.
You got to understand, because you can do your buy-to-lets on interest only, your mortgage payments are substantially less than if you did it on the residential capital repayment.
Yeah.
Hence why you can create these things.
Okay, so I'm not positioning it. I'm just writing it out. Where would you put? So obviously, there's every man and his dog is seeing. I could put something on Airbnb. So let's say the average person's got a shack or something that they're putting on Airbnb, etc.
That is service accommodation.
Oh yeah,
Just
true.
don't tell the mortgage company.
But would you still say Airbnb would get you around this sort of yield? That's the only reason I ask.
Some people do, and again, that like anything, that there is so many.
Yeah.
Yeah, you can put it anywhere on the scale.
Okay.
I'm going to talk anonymously as a mortgage broker on this one. People tend to try and do it as a residential. I'll move into my girlfriend's house and rent it out that way, but then it's a residential mortgage with all the costs and fees and capital repayments versus the Airbnb. But then you've also got people who buy to let and then also do the Airbnb. You're not necessarily allowed to with traditional mortgages. I'll just throw that in there. So yeah, to try and place it where is it, I think it goes anywhere from
Like that?
0% up to 20%.
Okay, cool. What else shall we place on here? In fact, just you guys shout out what we're going to do next.
How about commercial? What do we think commercial does?
Commercial. What type of commercial? Joy, what commercial would you like to focus on?
Offices, that sort of thing.
So, are we talking about buying an office block and then putting it out as a serviced office, or are we building the office block to then?
Serviced.
But are we buying the building, or are we building the building?
No, we're buying the building. Sorry.
So
That doesn't really matter if you buy it or if you build it. Because you can just combine all these.
Yeah,
you,
true.
you can do as a deal sourcer, you find a deal, and as a developer, you develop the property, and as a landlord, you rent it out. And then you could actually put the caveat on. You could also be the business owner that actually rents the property, but that's a different story.
What sort of yields do you think, Lars?
Anything between to be honest, like I say, it can go from minus to infinite.
yeah, I can see that as well. In fact, what would you say is the downside? Like, where's the lowest yield if you were to be completely retard it up?
5%, 3%, 2%.
Cool. Okay. So let's right.
The problem with taking everything from a scale of a crap investment to an excellent business is that now you're just on your argument of it's a business. If it's brilliant, it becomes the argument then, doesn't it? Because that standard Airbnb thing.
Yeah, and they're shit businesses and they're good, but yeah, everyone's different.
Absolutely.
It's all about the operator,
it's really difficult.
I guess.
Whereas so a basic average single let would be fairly poor, and the standard Airbnb is probably nets £500 per annum, because actually the standard Airbnb is terrible and nobody makes any money unless they run it properly. In which case it's a business.
Okay.
I think as well, there's a direct correlation, isn't there, between people in the house. So, yeah, for what it's worth, I think those numbers are about right.
Okay, so in order to speed, because I don't want we could be stuck here all day. Just a quick one, flipping, typical flipping like Kevin does. Where would you say that is? Infinite.
No, 10.
Oh, 10. Everyone agree, disagree?
Last one I did was 10.5%. So
10 up to 25, 40, 50%, I would say.
That high with a flip?
Yeah. I've done one which was 97%.
Nice.
I've done another that was probably similar sort of numbers.
Nice. Okay.
My background is accountancy and property.
Okay. So just to round it up this end, so are we saying that the worst yield we could do out of that whole basket of vehicles is, I guess, home, whatever home means?
I wouldn't class it as an investment. I'd say any kind of investment income from that is just a bonus.
Yeah. Okay. And is there, so what would you say on the other end of the scale, what is consistently doing good yield, would you say, out of all of these vehicles?
From my experience with my clients, I've seen a migration from your single lets to your HMOs and service accommodation.
Okay.
So student lets and HMOs are very popular, albeit a lot of them are going back from the student lets, from HMOs back to student lets.
Okay.
If you look at the traditional property investors, they start by renting out their, like I think someone mentioned before, that you have a couple,
Yep.
and they get together, they move into one house, they rent the old one out. So that means that they start with being single-let investors by accident.
Yeah.
And then they might buy another property to do the same thing, and from there they go into HMOs, which was the hot topic 5 years ago. And the last 2 or 3 years, the hot topic has been serviced accommodation. And then from there, you traditionally move into development.
Yeah, I agree.
Ooh, I like
Flip,
that.
Sounds
flip
about right.
renovations and then onto developments. The more complicated it is,
Okay.
the better the yield would be my view on it.
And you can argue that Kevin is a developer.
Yeah.
Yeah.
Adding value is, the way, So, Lars, just slowly, can you repeat that process again?
So you start
Typically.
by having two single individuals that have their own houses potentially, right?
Yep.
and then they move into one,
Yep.
and then they rent out and become accidental landlords.
Okay, so let's just do accidental.
When they're testing if their relationship works.
Okay, cool. And then if that goes well, then what do they?
They might get the appetite to buy another property when they realize that, oh, hang on a minute, it is actually giving us some money.
Yeah.
So they might do a traditional buy-to-let. Yeah.
Scale it a bit.
Yeah. Then they move into HMOs, which was the hot potato for the last 5 years-ish.
Yep.
And now that one's being substituted with service accommodation.
Okay, cool.
Some can argue that it's going back towards HMOs, but hey ho.
Service. Sweet.
And then from there you pretty much go into development. And at anywhere in this again, what Kevin is doing is basically the same as everybody else does in terms of having a single let.
Yeah.
It's just that he sells it on straight away, whereas some people decide, you know what, I'll keep it.
Cool. Nice. So, okay, so here's an interesting question. And we'll come on to your question, Mark P. That is a follow-on from this. So, let's say, and this happens all the time, a spectator goes, okay, I'm bored of being a spectator. I want to get into the wealth generation game. And they do eeny, meeny, miny, mo, and they go, right, property. I'm going to get into property. So they jump from standing start. They're all the way over here. They jump straight into, for whatever reason, they go, right, property is the thing I'm going to get into. Now, you said that this, oh my lord, I'm zooming in all over the place. So that is the typical progression. Now, assuming this, let's draw, this spectator has, I don't know, they've saved up 10 grand and they want to become financially independent through just property, no stock shares or anything like that.
The first thing they'll do is they'll lose the 10k by buying some property investment course.
Yeah, okay.
That's probably so true.
Okay, so in fact, not what
not
tends to
funny,
happen.
but
What
that is
would you
funny.
say? Okay, so let's rephrase the question, but that is hilarious. Let's say this is your son, your daughter, your newly adopted child. I don't know, someone that you really care for. Okay, and they're
First of all, 10 grand is not enough to actually get on the property ladder.
But-
And
yeah.
I certainly wouldn't tell them to go down the buy-to-let route first. They go down the residential route first.
okay. So this is all they
probably
have,
buy a
by the way.
property to
So
develop.
what would you recommend them to do? This is all they have to their name.
But-
And by the way, they got a job and they're taking home, I don't know, let's just call it 1,500 quid a month. And their outgoings,
Right.
let's just say they're after all outgoings, they've got 300 a month clear. So that's
So that's where you
I
have
wouldn't tell them to go into
to
property.
you have to go up to your original where you had debt as an investment, right?
Yep.
So as a parent, I would obviously lend them the money. So that 10k they have to their name, that could potentially be 50k to their name because you know what, Bank of Dad will put in the last 40.
okay. Assuming there is no Bank of Dad.
Oh, and this group.
The only way you could really get into
Rent
it
to rent?
is to find property, be a deal sourcer.
Okay. Deal source. That's actually interesting you say that. I was going to mention that because I saw a Samuel Leeds expose type thing not long ago, and there's someone like supposedly made some guy financially independent through property, and the guy said that's bollocks, and he then just went into deal sourcing because that was the only thing he found that he could make money on. Obviously, that's just one person with a beef, But if you had no money, obviously 10 grand in property is not really much.
You can JV with someone, so
Yeah.
you can go out and say, okay, I put my 10k in with, I use Bank of Dad, but it could also be your JV partner, and with that 10k you can grow it, and yeah. But yeah, 10k is a quite low starting
Yeah.
point in property.
So that in terms of that
Basically buy a friend or something like that.
so that would be like the money knowledge combo. Like this person would have to educate themselves so they get the knowledge bit, and they then need to go and find a money man or woman. Is that basically what you're saying?
Just quickly, the numbers that you put down there, 15 grand a month, 18 grand a year, you probably wouldn't qualify for most buy-to-lets anyway. If you're going down the residential, you're probably looking between 60 and possibly 75 grand that you can lend on that.
But if you're doing the JV,
I'd say the only way that this guy would get on the property ladder, if you wanted to start in property and actually physically buy bricks and mortar, would be buy a residential to develop. So buy a like Kevin does, where he actually buys it, develops and sells. He would actually buy it as a residential, do it up, and then sell it for profit, and basically step your way up that way.
not for 10 grand though. Surely?
For 10 mate, you've got 10 grand deposit on a 70 grand thing. You're buying a property for 80 grand.
Mm-hmm.
Buy a little flat, decorate it, sell it for 90 grand. You've got 10 grand profit and start moving on. There's also no capital gains tax. You've got no additional stamp duty from buy-to-let and stuff like that. So the only way he would get going would be residential, or certainly in my opinion anyway.
Okay, so let's just resi dev. Let's just call
Yeah,
that.
I agree. That was.
Yeah.
Is there enough spare capital though to do it up?
Maybe.
Would he have enough cap if he bought? Let's say he went north, bought something cheap.
Oh, he would have to live in the property, earn money, do it slowly. It's the only way I can see people doing it.
And what sort
The
of time
only
frame?
time he will leapfrog that is if he does buy with, say, a friend. So I get a lot of people coming saying, I'll work with somebody, let's put our 10 grand together, we've got 20 grand, plus the 2 salaries.
Yep.
Then all of a sudden the numbers do become workable. So just say they're both earned exactly the same. So I've got my spreadsheets open this side while I'm talking to you. So 18 grand, so collected 36, they're probably lending between 125 and 150 now.
Yeah.
Plus you've got your 20 grand, put a 10% deposit down and basically crack on from there.
Yeah. Okay. Cool. So really, what are we saying? So are we coming to the conclusion that this person or woman
Has to JV.
basically has to either JV or sell their leads?
Yeah.
Or start very small.
But then obviously there's that that seesaw of time and being
Oh
small.
yeah, 100%. 100%.
Yeah. Cool. Okay, so deal sourcing, JV, Resi. Okay, and I have zero affiliate links with anyone. Who would you say, and this is going to be an interesting answer, who would you say is the best place, company, person, resource, etc., if you really wanted to basically learn about deal sourcing?
Samuel Leeds.
Get on YouTube or speak to friends and family.
Okay, so YouTube, there's...
I'm biased because she lives in Bristol, but Susanna Cole is very good.
So,
Yes.
Susanna Cole, spelled like that?
That's the one.
Yeah.
I've got no contacts at all with deal sources as a mortgage broker.
That'd be it.
No idea.
I met hundreds of them, and she's that.
Okay. So, even more of a sort of facetious-y type thing. So, obviously, most of the big property education companies, like the big ones, I won't say names,
Aggressive.
they will all
say
have
it.
their own. Yeah. Are any of those conventional big education companies, do they have good deal sourcing courses, would you say?
Not from what I've seen. Trying to be careful.
Yeah, you have to. Anyone else?
I really
Obviously, expect.
don't
Yeah.
usually.
Any others have any good or bad experiences?
It all depends on how if you take and go into a local area.
Yep.
Where you basically get to meet with other experienced property, either developers, landlords, you name it.
Yep.
And by doing that, if I find a deal that doesn't stack up for me, or it doesn't time-wise fit into my system, I might pass that deal on. So that is deal sourcing.
Yeah, true. So I guess it's networking, I would say.
Yeah.
Networking, exactly. That is the and there is so. And I come from Simon Suchi's world.
Yeah.
And he has property meetings all over the world. All over the world,
Yeah.
probably UK. So yeah, that put it into Google, property invest.
Yeah.
I'm sure something's gonna come
Yeah.
up.
He's a really nice guy, Simon. I like Simon. I went to Morocco with him last year. That was fun. It's yeah. So okay. So
But yeah, Rob Moore does the same. I mean, Simon Suchi, Rob Moore is the same. Those two are potentially not scammers. Some of the other guys are scammers. We mentioned a name before that's in the meeting at the moment because they're going to court, right?
yeah. Okay.
But
It's a difficult one. I mean, me personally, I know quite a lot of them. I think they're all right. I've not paid any more than about £300 for a course,
Yeah.
and I'd be reluctant to spend out. I think all the knowledge is there for people to find virtually free of charge with networking, YouTube, and chatting.
Yeah.
We can do it with you, Siam, because we know that you sell courses of how to trade, how to do all kinds of things. So you are in that boat. And would you say that I could go out and YouTube everything you taught me?
I think it's
Most,
different,
probably.
It's more technical skill, so that's how I see trading. Sorry to butt in there, but I see that as a very technical.
So it's property investing.
Yeah, it is true. I guess education courses does accelerate the learning curve, and so it can accelerate you past lots of stupid idiot pitfalls that if you did self-teach. Like, it took me 6 years to hit break even with trading because I self-taught. Whereas if you were to join, let's say, the Real Estate Trader, you would definitely not take 6 years to, you'd instantly bypass all of those stupid errors. And I'm pretty sure with like property investing, there's all sorts of basic errors which you can avoid, which would save you thousands. Like, hell, I'm not even in property, but I'm like, from a common sense first principles type thing, if you're doing, I would say, in fact, this is a question for you guys, would you say it's advisable to deal in your own area?
Definitely.
Yeah, especially if you're doing like a buy to let, like you don't want to be taking the train up to Loch Ness every weekend when a tenant needs something.
Unless you've got a very good relations with estate agents in those areas, I probably wouldn't.
Okay. Yeah. So that's another follow-on question. So where do we go from? So let's say you've got a buy-to-let, basic single-let, you're doing anything between this yield. That's if you're doing it. If you were to then palm off all of the responsibility to a letting agent to manage it, how, in percentage terms, how many percent would that take off your net yield, would you say? On average, would they take off half of your net yield?
So I can only answer it in numbers. You'll be charged anything between 8 to 12% to manage your property
per month of the gross rental income.
Per month. So if you have £100 rental income coming in, you'd be looking at between 8 to 12%.
Okay.
And the thing is, you need to look very carefully at what they do for that, because although some might charge slightly more, they wouldn't enhance things like getting a plumber out, cost you 50 quid, well, they'll charge you £100 for the benefit.
Yeah.
The agents will charge a fraction more, but they're not hammy on that stuff. They just pass the forward cost to cost. So definitely research your agents before you engage in one. Make sure you know what you're paying for.
Okay. Cool.
And back to your young person before, that's where they can also start earning some money, that they can actually do property management.
Okay. Yeah, so in fact, we can actually, and I guess that would be a good place to learn the ropes, I guess.
Can be, yeah.
So
right now it would be a terrible place to learn the ropes, because oh my god, you're talking about starting an outrageously manual full-time business. I think you'd struggle to start one from scratch unless you had 100 clients.
Oh, okay, fair enough. Yeah. Cool. Bear in mind, it's not that you would not be financially independent from doing it. It's pure and simple that I only have a little bit of money.
Yep.
You want to be into property, so therefore you are in the property world.
Yep.
Okay, you only get. I have friends that have, for instance, got people that, for instance, the toilet's blocked. Yeah, they'll charge him 50 quid, but you sort it.
Yeah.
So that's the way of getting a little bit of money in. You get, like you said, Simon, you learn a little bit about how the property world works, and you earn a little bit of side money on it. Yes, you are not financially free.
But I guess going back to the main question is that this personal lady is trying to get in. Okay.
Get in and do it.
Yeah.
I think it's the best way to learn. Maybe part of the training for later. Get in and learn, and if you can definitely add value and low down in the market, I think it's a no-brainer.
And would you
depending on the economic environment, of course, but
cool? And would you say that you would actually need to get in the weeds and learn all this stuff before you're even attractive enough to do a JV, where you are the doer person, the knowledge person, and
Absolutely, 100%. Yes.
sorry, was that a yes or no? I heard.
I disagree. If you've got two friends coming together, I've got guys who do this frequently, where you've just got two people. Listen, we've got a bunch of money, not enough to do it ourselves, but do it together. I think you both go in pre-blind. I think that's where you need a good support network, a good accountant, good mortgage broker, good solicitor, sort of thing.
But then you're kind of both the money and both the knowledge, aren't you? You're
Correct.
modelling.
Yeah. Well, you're learning as you go as well.
If you're the knowledge,
Yeah.
this is the thing that I like. I quite like talking about Simon Zushi. I go to his PIN meetings in Bristol and
Cool.
Swindon almost every month. And since the property train taken off and tons of people do it, people are an absolute nightmare because they think that their in is to joint venture, but they've got nothing. They've got
Nothing to bring to the table.
No knowledge.
Yeah.
Yeah, not to be rude, but they're not bringing anything. They're just bringing enthusiasm, and which is great.
Yeah.
But there's just hundreds of thousands of those people seem to be.
That's so true.
Yeah, but if they've got the money to add to the party, so if you're the knowledge
this
and
person
they've got the money, then it's slightly different.
Yeah, that's it. And when you're joint venturing, if you both put in money and you're both doing it, that's different. But that doesn't
Very
seem to
different,
be
yeah.
people seem to believe that there's these like people sat around with millions of pounds who just need it, just cannot think of anything else to do than give it to you straight out of the
Some random person with no experience in property.
Yeah.
Yeah, that's it. Yeah.
Okay.
And I that's the thing that makes me a bit sad.
Nice. So,
Yeah, I hear that.
looking at the chat box, Property Tribes, yeah, thanks for that, Gavin. What else is there? So, where does that take us now? Oh, yeah, Mark P. So, Mark P has said, so what are people doing different in property at the moment to profit, given the current situation? Okay, so I guess let's move into post-COVID. So, here we go.
We're not there yet.
Oh yeah, true.
We don't know. That is the unknown, isn't it?
Yeah.
No, I can actually answer that from a broker perspective. I've actually got quite a lot of people contacting now doing stage one interviews, which is how much can I borrow, what are the mortgage, what are the costs, and all that sort of stuff now, with the view that if the property markets do correct, go up, down, sideways, somebody's has to sell for whatever reason, they may be able to pick up a couple of good deals. So what they're doing is in their pre-research with someone like myself now to find out the numbers so they can start looking for properties once COVID is lifted.
Okay. So, at the moment, okay, there's all sorts of different questions here. So, obviously, if you're an experienced property investor or experienced property operator, you are no doubt going to still be able to squeak out some profits. Would you agree? I guess that's the same in any niche, right? If you know what you're doing. Yes.
I personally think you're stopping the bleeding, so you're identifying where in your portfolio you've got bleeding. You're stopping the bleeding. Then you're where you can increasing your income. I think you're also gearing up, if you haven't already, in preparation for a recession and some buying or lease opportunities. Maintaining good relationships with existing clients, I guess that's linked in with stopping the bleeding, looking for opportunities, and maybe doing some base level legals and getting your finance in place, ready to go. And that's not to say go, because I don't think it's time to go yet, but being ready and at the front of the queue to go when they release everything. And in conjunction with that, in order to stimulate the economy, I think the government will introduce all sorts of different buying incentives, and that window may only be open for a short amount of time.
Okay.
Yeah, that goes on to exactly what I said about the stage one interviews, is knowing your numbers before you start. So once things lift, if there is a good deal to be had, you're at the front of the line, you know your numbers, you know what you can go up to, you know the costs, you've got the money ready and waiting.
Okay, so
Sorry, can I ask you a question? Why do you think the government needs to stimulate the property market?
Well, I think it's my belief, and again, it's just an opinion, that I think they will try and stimulate all of the economy, and I am concerned that property prices may dip. I think it'll be temporary. I think with the I think there will be some redundancies. There will be impacts on people's jobs.
Yeah.
There will be impacts on other areas of health. We're starting to see, aren't we? Some lenders aren't lending. Loan to values are increasing, meaning you've got to put more money, more deposit down.
Yeah.
So I think there will, and I think the unknown and the fear. So it's my belief that there will be a drop. I think it'll take a bit of time to come in. And then I think the government will introduce incentives, will be more certain when we get a vaccine and things like that, and then property prices will go. And I think as well, people, and I'm sort of stealing your point, Siam. I think all the points that you've made over the past couple of weeks with the presentations you've done are good and solid. So we talked about people hoarding cash and things like that. So people perhaps won't want to buy straight away. They might hold off on the big luxury purchases. They might reconsider. So I think the government will have to stimulate the economy. I think we might see some stamp duty percentages reduce. For all we know, we don't know how long this will go on. There could well be incentives for people from businesses and the economy to work and educate from home. I think that's a bit far-fetched, but stranger things have happened, haven't they, like the grants and things like that. So that's what I foresee happening, but who knows?
okay, so I don't want to leave anyone behind here with some of the questions. So Mark has said in the chat box, he's asked, so would you say now is the best time to invest in property? I've asked for a bit of an elaboration on that, because invest in which bit of property? So I guess we've sort of covered that. So Roz has said commercial to resi conversions could be lucrative. It's usually a good strategy, but maybe even better, as commercial could go lower than resi. Thoughts, people?
Commercial to residential conversions are so massively overvalued at the moment that it's really dangerous. Yeah, they could be really good, but we sell commercial property on such higher values now because of the potential for residential, and they just keep getting higher and higher. So not here, not in Bristol, not in the southwest, not where we are. People are paying far too much for it, so they'd have to come down. Then you're just, the square footage purchase price between commercial purchase and a residential sale just has to be correct. So as long as it stacks up, it doesn't really matter if values go up or down. That's the arbitrage bit. That's what you're doing. You're commercial to residential, so it doesn't really matter if commercial falls in line with residential, but that bit in the middle stays the same, and you've got your margin there. It doesn't really matter. But a lot of that is going to be down to borrowing, really.
Yeah. And what would your...
That's true. Yeah, I was just going to say, I think, people talk about commercial to residential conversions and assume that it's kind of offices, and quite rightly, as you just said, like office prices have gone through the roof in the last sort of 4 or 5 years, but you can still buy mixed use or large retail spaces at £40 a square foot, and in the majority of the country that makes that viable, because you can convert it for 100 and maybe create something that's worth 200. So I think commercial to resi get bandied about as this loose term, a bit like property does, and there's nuances within it. Large offices, it's been overdone, and there's a reduction in supply, which has then caused the values to rise. And yeah, that's not an easy game just to be lumping into. But there's definitely still value out there in commercial premises at today's prices before they've even dropped. And yeah, nobody really wants to be buying retail, but if you know what to do with it, then that's good value, isn't it?
Yeah, I think when people say commercial to residential, they largely talk about permitted development, and it's that type of stuff that we just sell at mad money at the moment. So yeah, if you're talking stuff without permitted development, then you're just talking about development.
Yeah, but retail and banks all have PD as well, but most people don't realise that. So
Yeah,
stick to its offices, don't they? But I don't see retail being sold for astronomical prices, and you can convert upper floors to resi without even prior notification, can't you? It's literally turn up with your tools and you can start the next day. But
yeah.
you know, banks, great value as well, and very cheap, especially the bigger old sort of Victorian ones. You get lots of square footage for the money. And if you know what to do with it, I mean, you can even convert those to offices through PD, can't you now?
Yeah.
So, it's so broad.
That's it. It's just, to me, that's just development. It's just, if you've got your margins, it doesn't really matter what.
Exactly.
I think we might be talking cross purposes. I think we're fine.
Okay. So, a couple of things. I've got a few different questions. So, what are all your thoughts on loading up on debt right now? As in getting as much cash as possible via debt, etc., in order to pounce when you perceive there to be the low. Now, obviously, that's a massive question because there's too many variables, but I guess, what are your thoughts? Like, for me as an investor, ignore property, for me, I am massively loading up on as much debt as I can, because I see a massive big inflationary period coming over the next few years, and I just want to basically divest or basically convert that cash into non-inflationary assets. Easy thing like Bitcoin. I'm not saying I'm going to go all in on Bitcoin, but Bitcoin, if the currency supply grows massively, or the Bitcoin supply is not, if anything, it's slowing down. So the normal demand and supply, Bitcoin should go up. So that's one of the reasons I'm loading up on debt, and also because I want to be able to pounce on opportunities over the next couple of years with good businesses that just need cash capital. What about property? Is anyone here loading up on debt in order to pounce?
Yeah. Property and other things, trading, I think, potentially buying businesses. I think debt is cheap at the minute. Debt is nominal, as you've said before.
Yep.
Fixed rate debts, cheap government loans, all those things. It gives you options. It gives you choices.
It all comes down to economics on your deals anyway, Siam. I think it's all a numbers game, and then also all the risks that are associated with taking debt. So yeah,
Correct.
Fine. Low interest rates. Is it secured? Is it unsecured? What are your risks?
Yeah, true.
Loading up on things like bounce back loans, great, because you get free money for a year plus 2.5% thereafter for a fixed period. That's great. It's cheap money, cheap debt, unsecured, fantastic.
Yeah.
But it's still got to make sense to whatever venture you go into.
Yeah.
And then it just comes down to opportunity cost, in terms of what your direction is. Is it property? Is it investing in, or trading or whatever? So,
Yeah, just making comments on the bounce. The bounce back loan itself, if you look at the T's and C's, you've got to use it for the business that you're drawing it down for. So you can't take the bounce back loan, whip it out your limited company and go start buying property, because it's not for business purposes. So you just need to be a little bit careful with that one. But on the flip side, the debt is so cheap at the moment. I mean, getting rates of 2.5% interest rate for the first year. Mortgages are the cheapest I've ever seen them in 20 years in the industry. So yeah, I'd say there are people remortgaging to release equity so they can buy further properties once the time is right. But I think you need to be an experienced landlord to be able to do that. So wait for the property corrections, find the right property, right return, then buy.
Okay. And the word correction also, yes, Lars, go for it.
How is all this debt going to affect your credit score and your credit file?
It's a good, valid point.
Because it's not going to go away.
Can I answer that one?
Yeah, go for it.
So if you, talking from a residential standpoint, if you came to me and said you've got loans, credit cards, car HP, that automatically reduces how much we can lend you from a mortgage going forward. If all of that is done through your limited company, and you said my accounts will show I'm earning 50 grand a year, we'd use the 50 grand, there's no problem. So anything in your personal capacity would definitely affect residential mortgages going forward. What they've done in the last 10 plus years since the last credit crunch is, even if you've got zero debt, but you, for instance, got 5 credit cards with, say, 10 grand limits, but you don't use any of them, what they're also now doing is looking at your potential for indebtedness. So they'll say, well, you've got 5 credit cards, 10 grand limits, so you could blow 50 grand overnight, and I've seen applications be declined because of that. So they are keeping a very close eye on how much debt you've got, but also your potential for indebtedness.
Yeah.
How it works with businesses is not my cup of tea on that side, so I can only answer from a residential application in that sense.
And as you, Siam, then you frequently buy businesses. So let's say you want to buy my business,
Yeah.
and I had to take out massive amount of government debt now because whatever reason.
Yep.
Wouldn't that be a red flag for you? That my business was not basically sustaining on its own. I had to get all this debt to continue. Isn't that a red flag?
Possibly. I mean, like with I guess everything is so detailed and has so many caveats and minutiae. Like when I buy property, I don't buy property. When I buy a business, I have my own set criteria. So my business buying criteria is that it needs to be doing 300k net profit minimum, 3 years of accounts minimum, 30% net margin minimum, management team in place, scalable online, and congruent to my existing empire. So that's my personal criteria. So for me, like, I won't even enter. So, and I guess there is a caveat to that list, which is debt. Now, some debts I'm not too worried about, but some are. So yeah, I'm really picky with what I buy. Just like some of you may be really picky with, you're only looking for a certain type of property within a certain area to, and it has to meet your, calculations. Just like Brad said, your personal economics is crucial there. Yeah, I think it's a big. I mean, yeah, it's like, are you a boobs or a bum guy? Like, there's no right answer. I don't think. Sorry, not the.
So is it? I mean, I would answer that, Lars. Is it what I would class as, taking into account my background, an accountant? Is it good debt? So could it be secured against an asset? What's your net asset base? Is it strong? Is it good? What's your existing credit history? What additional funds, emergency funds, have you got in place? So I'm in the middle of a remortgage on something at the minute, and they're starting to ask different questions, and one of them is, what's your COVID strategy? What emergency funds have you got? Blah 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 blah. So if you can provide evidence of those sort of things, I think it'll be relatively easy to get debt. So, and I would always go for a more cautious approach, a more prudent approach. That would be my angle.
But isn't that the issue, that the debt is so easy to get now? In relative terms.
Yeah, but it's for you to manage it, though, isn't it? You only take the debt that you need strategically, opposed to just filling your boots and then hoping for the best.
Yeah, and I do think there will be some really good opportunities. It's just a matter of when, and it's a personal choice as to whether you what's the word?
But it is like walking around a loaded gun, isn't it? It can save, so it can also kill.
I think it depends how good your financial management is. I know there are some external factors that you can't control, but maybe build in a big safety net, and depending on your risk appetite, you can alter that safety net accordingly. It's just my thoughts. I'm a low risk. I'm more of a calculated risk type of person, I think. And I would hope that I would never overextend myself, but I would like to make the most of the opportunities as and when they arise.
And that's a fine balance, isn't it?
Yeah. Like you said, it's a double-edged sword. I've seen debt, people loading up in debt and becoming multi millionaires, and I've seen identical people in identical situations do exactly the same thing and end up on the streets. So yeah, it's how, I guess it all comes down to the operator. Like, you could give the world's best business model, best staff, best whatever to the world's worst director, and that director will still plough that business into the ground. Whereas you could give a really good, skilled business operator to, you know, a shit model, and it'll make, like, if you gave Elon Musk a shit business model, I'm pretty sure he'd do all right. So it really does come down to the individual. Same with trading.
Yeah, but that all comes back down to financial education, though, doesn't it?
Yeah.
So, you know, if you're talking about property as do you or don't you invest, there's probably a lot of people, I'd say, don't bother. For those who've educated themselves into it, then there are going to be opportunities about, aren't there?
Yeah.
So it comes down to your financial education. You shout about that all the time. It's just keep reading, keep educating. So when the opportunity is there, that you're educated enough to make the right decision.
Yeah. So Gavin in the hood, sorry, I just can't move this 1 second, has put in the chat box this. Do you see the big risk with property being that it's an inflation hedge asset but will ultimately tank in price due to inflation and subsequent interest rate rises? Thoughts, people? Sorry, has my computer frozen, or is...
No,
Oh,
no,
no.
we don't know how to answer it. I don't completely understand the question. So, inflation hedge asset.
So I think what he means by that is that there's only so much land, there's only so many properties that can be made, or etc. So if there is runaway monetary inflation, i.e. the Bank of England just goes, right, fuck it, there's £5 trillion worth of QE type stuff tomorrow, or helicopter money, obviously that money will then eventually trickle down, and it tends to be absorbed by stocks and property anyway. So if there's runaway monetary inflation, that typically inflates stocks and property, as in the prices.
I think this is probably a likely outcome, isn't it?
Yeah,
You know,
I agree.
eventually there's going to be some inflation. That's why I'm kind of bullish, sort of medium term, like, because, and to load up on debt, because your debt's just going to be eroded, isn't it? And
Yeah.
you know, so without being stupid, like, you know, if you're at 75% loan to value on whatever your loans be, whether they're, you know, commercial, buy-to-let, whatever, then holding assets such as that are good in that sort of climate. So,
Yeah.
and that's probably a likely play on how this is going to roll out at some point.
So can I just ask about a practical example? So let's say now a property's worth 100 grand, the debt is 70 grand, let's say. So we're saying in this scenario, with all the quantity of easing going on, property prices will increase in value. Is that what we're saying? To 130k, let's say.
So you said 70k debt, did you say?
Yeah, 70k debt, assets 100. So that's before Corona.
Mm-hmm.
Now, after Corona, what are we saying with the inflationary hedge asset point? Just to make sure that I can completely understand what you're saying.
Oh.
So we're saying that we think the asset will rise in value.
Price.
Not necessarily. Like, you know, I think it likely will, but that's a different sort of topic. I think the point is that the debt will be less in an inflationary environment, won't it?
Yes, correct.
Comparatively. So 70 grand in today's money will be, you know, 50 grand in tomorrow's money. So therefore, debt is good. You know, from that point.
You could argue it both ways. So you could argue it to say there'll be a lot of inflation. So that means in this scenario, let's say the property will go to 130 grand. Your debt is still 70. So your net asset position is 60k.
Yeah.
Or you could argue, and I know this is one of
But your cash is
fears,
always then worth less as well.
Correct. Yes. Yeah. You can't buy as much in the shops because everything's gone really expensive.
And like as Gavin said in the thing, he said it will feel like we should get into property before inflation hits. Yeah, so that is the trick. So as you said, Gavin, timing is crucial. So if you are going to do that play, i.e. the play of loading up on debt, jumping into non-inflationary assets before there is runaway inflation, monetary inflation, then yeah, the time is you have to do it beforehand. And like, I think I'm a student of money, and a really good place to look at is Zimbabwe, because it's relatively recent. And in Zimbabwe, everyone thinks that everyone got destroyed monetary or financially, which is, I guess, correct. A lot of people did, but there were handfuls of people. There are groups, entities, companies, and people that were like, amazing. Like we're going through 69 sextillion% inflation here. You know, where restaurant prices would double every day or every week, or, you know, depending on what time. And so there were some people, let's just put, you know, where they're like, sweet, I'm going to load up on all this debt. I'm going to buy a town. Let's say the town, I don't know, $1 trillion worth of, you know, it's cost me $1 trillion in debt. That's what they've loaded up on the debt. But then when runaway inflation, monetary inflation, have to emphasize, went nuts, and they were doing, you know, quadrillion dollar whatever, all of a sudden they could pay off that whole $1 trillion debt in like a week's worth of earnings or a year's earnings, etc. And so there were loads of entities that ended up owning huge swathes of Zimbabwe just because they played it right. However, there were also people that did the same thing, end up with shitloads of debt, but they got greedy. They tried to buy other towns. They kept on loading up on the debt, etc. And then it all fell through. Currency defaulted, and then everything resumed to the dollar, US dollar. And then guess what? They're like, shit, I've now gone from owning 10 towns to I'm now bankrupt. So I think when you're looking at history, greediness is not your friend. Like, you can probably get in a good you know, have a good play and like end up with the town debt free, but then don't try and own lots of cities. Does that make sense? I've sort of gone off on one, but I think this is a very hyper extreme example of that play. Does it make sense? Yeah. And I'm not saying we're going to have hyperinflation in the UK. I mean, anything's possible these days, but I'm not. Yeah. So so let's move on, because I just want to quickly move that question up there. Right, so I've heard a few people online say, you know, the government, they're going to have to reinflate the, you know, the property prices, keep the property market up, etc. And my instant internal question is, why? Like, why do you think that? Why do the government have to prop up property prices? Now, there are economic reasons why, you know, the Federal Reserve may want to prop up the stock market, but I think obviously there's all sorts of new variables, but
people think they're rich when they have a house.
Yeah, correct.
And house prices always go up, so I'll get richer and richer and richer because my house will always go up.
Increases consumer confidence.
Yeah, but the thing is, in reality, higher house prices actually hurt the economy, because when people look at the I guess the health of the economy, they think, oh yeah, stock market's going up, property, like as you said, is going up. But one of the key factors is aggregate value. So basically for every £1, so in a booming economy, in a rising economy, for every £1 spent, invested, or moved in the economy, should give you £1 plus in growth, etc. If that makes sense. And when you're in a falling economy, I'm keeping very basic here. For every £1 invested, spent, used, whatever, it actually results in, you know, 90p worth of economic growth development. And so this is when you end up in a bit of a spiral. We're not there yet, I don't think, or we could be, you know, 1 for 1 at the moment. But when you enter like a crazy, depression, this is why a lot of stimulus doesn't touch the sides, because you actually, you know, for more money you're putting in, it's not adding any extra economic activity. And so going back to, you know, a very basic principle, higher house prices hurts the economy, because if you have higher house prices, guess what? The mortgage repayments are higher. So, one second. So, typically, I'm being very black brush here. Mortgage payments, payments go up. It also then entails that rental, as in the rent also goes up. But ultimately, all of that means that people have less to spend in the economy. Because
aren't they controlling that by lowering the interest rate, letting you borrow more money against the house?
Yeah.
And also eventually that
it's just a kicking can down the road thing, though.
But that is the reality, isn't it?
I agree with the kicking the can down. I just think that if the government will need to support every area of the economy in order for it to grow, and I think with 65% of UK people being homeowners, and all the linked industry to property like banking and building and everything else, it's something like 8-9% of GDP. They will need to prop it up in the same way that they're propping the stock market up, and it's a vote point, isn't it?
Yeah.
Because it's a vote winner.
Yeah. And
I agree that it's political rather than economical.
Yeah.
I agree. Yeah.
Because this.
I think the economics is all good, definitely.
Yeah. It's just that going back to this point, as in, the more people have to spend on their mortgage or rent, they then have less portion of their disposable income every month to spend in the economy, and it's this bit here which is one contributory factor to a rising or booming falling economy. And typically when you do have high house prices, the reason it hurts is because house prices is not increasing in line with household income. So that it's this gap of pain which hurts people, because
but doesn't that slow the market down though, and slow the increases down while you wait for it to catch up? Because eventually you're going to get to a situation where people just don't earn enough to buy a property, so that will slow the economy down. I mean, they did that in London, and thank bloody goodness prices slowed down. They were increasing so fast that nobody could actually keep up. So the problem is, if you're not, I've always wanted to ask the question. I'd love to hear what people's responses are. If people aren't buying a property, they're going to have to rent. So which is the right one to do? Do you continue to rent, or do you buy own residential property? So this is not an investing question. This is more a case of, would you prefer to rent? Would you prefer to own your own residential home?
Depends on your own circumstances and I guess risk appetite and what you want. Everyone's different, I guess. But just quickly before we move on to that question, I forgot what you said. But yeah, this is the pain, that's why it's bad. But then talking about lowering interest rates and all that sort of stuff, it's just a big kicking can down the road. It's basically just having a massive shot of heroin or cocaine, etc. All these QE type stimulant type practices, because eventually all that does, when the government tries to meddle with a free market, well, there's no free market these days. So all that happens when these measures go in, like, we're going to prop up the property market. All that happens is this happens. It probably slows down a bit. But this, still does this. So all that happens is that this gap of pain just gets bigger and bigger and bigger. And then eventually, again, just looking at history, I'm not saying it's going to happen here, but when you just look at history, that is what happens. And eventually, this little correction comes in line. So it not necessarily crosses it, but it may get to a point where it goes back to a level where, there's a certain, it's like a rubber band. Like everything has a rubber band, and like the rubber band in this case, let's say everyone's happy where the gap is like that, but when it gets like this, it's like, well, the rubber band, it will snap back to, the thingy. Sorry, gone off on my one on analogies. But yeah, what was your second point, Justin? Before I interrupted.
So yeah, I was going to say the whole do you buy or do you rent question.
That's a good question.
Always struggle with that one, because if you're not buying, you're going to have to rent, and you can only live with mum and dad for so long if you've got a mum and dad. So it is a question. If you said to me, providing of course you've got small deposits in that, but in most situations you can buy a property, albeit a smaller one, for substantially less in a mortgage payment than you would in rental payments. And I think rental payments are actually being abused at the moment, because they are increasing quite dramatically. Certainly if you look at places like London and places like that, it's ridiculous. You've then got the second question of, if you're renting, I'm at the mercy of the landlord, who may or may not be deciding to sell the property and do all sorts of things, where you're now in control by having a mortgage. As long as you, I mean, I'd happily work at Sainsbury's, Tesco's, a car wash to pay the mortgage payment, but I know that I'm not going to be kicked out of my own home.
Yeah.
But this is more about owning a residential property, not investing in property. That is very different.
Yeah.
But you're only allowed to live in your house as long as you can pay the mortgage, right? You get kicked out the second you don't pay the mortgage.
True.
So that was
Absolutely correct. So if I'm renting, is my landlord going to allow me to live there indefinitely when I'm not paying rent?
But if you're renting, you can just rent somewhere else.
Yeah, but if you haven't got the money to pay for it...
Same with the mortgage though,
So
or the council tax. You stop paying your council tax, even though you may own your home outright. Look how long it'll take until you lose your house.
Yeah, okay. So then go to the second part of the equation is, I'm your landlord and I decide I've got myself into difficulty selling the property, whatever the case is, I'm kicking you out.
Yeah.
You've got more control over the roof over your head by owning your own residential property, and probably work out a bit cheaper as well than renting.
But if you, as the owner of the property, are becoming a financial problem and therefore can't pay a mortgage, you will get kicked out.
Mm-hmm. But then the same's true for rent, because if you can't pay your rent, you're going to be kicked out as well.
Yeah.
You've probably got longer.
It's just one of those questions.
Because of all the the rules against repossessions and how long things take, isn't it? Isn't it about 2 years before they can get you out of your own home?
Yeah, there's a huge period of time, and they have to absolutely demonstrate they've done everything in their power to keep you there. So you could be on a repayment mortgage, maybe converted to interest only, which drops your payments ridiculously given interest rates. You know, if you're still not paying, then yes. So I would say you've definitely got more control over yourself and your family's roof over your head by owning a property than renting.
Yeah.
Yeah, it all depends on your circumstances. That if you are a transient person, then yes, you would be better off renting, because then you have the flexibility. Like if you were a transient person, that, hey, I'm an airplane pilot. If I had to move now to fly an airplane, then I would have to sell my house. That's not a great time to sell it.
Yeah, I know. So you were just sort of normal person and normal run of the mill. If you need flexibility to move around, makes sense more to rent in that instance. Yes. Yeah, that.
Sweden's a net renter nation, isn't it, Lars?
No.
Is it not?
No.
Which? Okay. Is it Finland or Denmark?
I'm not from Sweden, by the way.
Oh shit.
Are you from Scotland?
Sorry?
Are you from Scotland?
Sorry? Oh my god, I thought you were Swedish.
Swedes and Danes are like English and Scottish, right? So don't insult me.
God. All this time I thought you were Swedish and you're a Dane.
It's fine.
Oh shit. Sorry, mate.
So I've got another question for you. So if you're not buying a property, okay, and nobody's buying properties to rent out to all their tenants, who's actually owning those properties to allow you to rent them in the first place? Somebody has to own those properties at some point.
But there is people having, when I say many properties, right? But that is one of the things. So let's say that I saw Siam put up further up the market freeze. So let's just for argument's sake say that the entire market completely froze over now, and I have HMOs and I have single lets. So if the market for HMOs were to explode because more and more people need to rent something, but we can't buy anything and all this, I would have to convert some of those single lets into HMOs then, and therefore
So that's good. That's good for you.
So that's and back to the there will be people buying, aka us property investors. Because
Yeah.
we have an appetite for buying these properties, so we would like to buy properties to rent out, because and so it's a win-win for us, really, right? So that's actually the dream scenario for us, is that the rental market goes completely bonkers, because that means that we get income.
Yeah.
Yeah. I think the common theme I've heard throughout the whole Zoom thing here is, if you're an experienced person, know what you're doing with the right support around you, probably not a bad thing to invest in property at the right time. And I think the key thing here is finding the right property at the right time, opposed to just willy-nilly going into a market and just trying to become an investor and waste your money, basically.
Well, when we say the right time, throughout history, property has been a good investment. Yes, granted, there has been a dip. We saw a dip in 2009 or 8, where it corrected 20%, and it took it 5 years to get back to that level again. But other than that, if we zoom further out on that chart, we had if to use Siam's trading terminology here, right? And from 1997 until 2007, oh my flipping God, I wish I was 20 years older.
Yeah.
I mean, if you bought a property, if you look up the historical UK average house prices, in 1997 you could buy, the average house was 55,000 thereabouts, and in April this year, we are at 223,000 pounds.
Hear you on all that.
So in terms of timing, yes, granted, it's like stock market investing, right? That if you take the Dow Jones and zoom out, did timing really matter? If you had bought into the Dow Jones 20 years ago, does it really matter when you bought it in at I can't remember what it was back then, but let's say it was 10,000, and now we're hovering around 25,000. Did the timing back then really matter?
No, but that's a long-term buy and hold. So I totally hear you on that. I'm actually of the same. I do agree with that. So if you're going to buy and hold, then that's fine. I think if somebody's trying to dip their toe into the market, then you need to be a bit careful. But if you knew that there was going to be, like 2007, 2008, you probably wouldn't have bought a property at that point. You probably would have waited for things to settle down, then buy your next property. You wouldn't go with pockets full of cash going, I'm going to buy every single property at the top of the, when you're about to know there's going to be a credit crunch and stuff like that. So it's like any type of investing is investing with your eyes open,
That's a choice of strategy. So like at the moment, Jive is not doing fantastic because we're not in a trending market. So property flipping in this market, that's a bit risky potentially, because if Kevin goes out and buys property tomorrow and we see a correction over the next 6 months going negative, he's underwater.
But the thing is, you only realise your loss when you actually sell the property.
And that means
and if you plan to hold, then different story.
Anyway.
So
that was the comment on time.
Yeah, I was. So I want to round this up at 5 o'clock. So in 12 minutes. So just let's do quick ones with this. I think we've sort of touched this. So at the moment the market's frozen because no one is. I think the main reason, I think Justin, you mentioned this a few days ago. The main reason the market is actually frozen right now isn't because of
it's not because of buyers and sellers and stuff like that. It's because of the valuations. People can't get access to valuations.
Yeah.
But the lenders are currently adopting technology that's been around for many, many years to try and do remote valuations, AVM, desktop values and stuff like that. Traditionally used for internal remortgages. So I'm with Halifax, deal's expired, Halifax offers me a new deal. They use an internal valuation system called an AVM. What they're now trying to do is allow you to do that in between banks. Behind the scenes, what happens is they've got the internal valuers who are kind of looking at these and going, does it sound real or realistic? If they're struggling with that, they're then going out to some of the bigger firms to give their opinion, or they'll use a local surveyor to add their thoughts at the moment. So this is all evolutionary as I'm talking to you. I mean, it's really interesting watching this happen. But yeah, the market freeze, as I'm seeing it at the moment, is really down to the valuation, because I've still got people buying properties as I'm talking to you, people who've going through the purchase who actually had offers accepted whilst we've gone into lockdown, so they'd viewed the properties previously. And I've got a lot of clients actually doing the stage 1 interviews in preparation of potentially finding properties once the lockdown is lifted. So I think at the moment it is going to be purely down to the valuations. Somebody mentioned about the lenders not lending in loan-to-value restrictions, and that is because they can't do the valuations to get the loan-to-values higher, so they're having to be a little bit more cautious on their risk, hence why they're using the AVMs. It was at one point we lost well in excess of 50% of products, and that was down to the sort of 65% banding, because even if they got the prices, the AVMs wrong, they still had enough buffer to probably soak it up. They've gradually increased that back out to 75. We've now got lenders who are talking about 80% plus again, and that's all based on AVMs.
Yeah.
That is interesting. I am one of those people who's got one going through it at the moment, just waiting.
Right.
Yeah. For those who are listening, you're not sure who this Justin person is. It's Justin Fordham. As mentioned, I don't earn a thing other than cuddles when we meet at poker, and then I take his money when I beat him at poker. So
he's an Australian.
Only if I'm talking to you, Kev.
It's like Lars is Swedish.
Yeah, I'm so sorry. So yeah. Okay. Other question. So follow-on question. Ignoring what I think, what does the group think? Okay. Let's say lockdown ends. Let's say at some point we're going to be allowed back open to a varying degree. So market opens again. What does everyone think prices are going to do? Obviously, it's just like saying, what price do you think Bitcoin's going to be in 2 weeks' time? I don't know. No one knows. But what is the general consensus of this group?
Decrease.
I think while the wheels get back in motion, there might be a slight correction.
So, okay, so 3 for down.
I think the properties that it's my personal view, outside of anything other cataclysmic happening, I think the properties that are going to be staying on the market are those people who are looking to sell quite quickly for whatever reason. And I think if they are desperate sellers or motivated sellers, the chances are they're going to reduce the values to try and shift the properties. I think once we see the economy picking up, people going back to work, not as many people losing their jobs and so forth, I think the prices will obviously stabilise at that point. Then it's anybody's question after that.
Okay. So we've got 4 for down. Anyone? Okay. Is anyone thinking price is going to go up?
Short term up, some more correction, and then go up again.
What? So Lars, you said down and then up. Did you?
No.
Up then
Up
down.
a little bit. Correction a little bit.
Okay.
And then up.
Okay. And then.
But not the down. No. That's way too big.
No, I meant. Sorry, this was like as in up and then down. Yeah. So.
Yeah, but not down.
No. Okay, I wasn't. Yeah. I'll just leave you out of it. Cool. Okay, interesting. So, I guess I need to move this question forward. I guess this goes here. So, I'm sure there's probably some people thinking, well, okay, I'm looking at a house to buy right now, blah, blah, blah. I'm not, but as in, let's say someone is. And they, distressed seller, the person, wants to get out, and it's 20% BMV. So there is an argument saying that if you can find a house, 20% BMV now, it's probably worth buying, because even if the market does crash 20%, then you'll break even. What are your thoughts on that sentiment?
It depends on how you finance it.
Ooh, yes. Okay.
Good point.
Yeah.
Good point. And it depends on if you're looking to flip it or whether you're looking to hold on to it long term. Because if you're long term,
then yeah,
I would buy any share right now in the stock market because it's 30% reduced. If it continues to fall and then eventually works its way back, well, I've still got 20% reduced from where it was originally if it goes back to where it originally was. Same with this property, but if you're looking to flip it, you'd need to know what you're doing.
Yeah.
If it's longer term, I'd say why not? Because then you go back to your statement, Siam, of do you always time the bottom of the market? Certainly when you're trading, you try and take the low-hanging fruit. The only time you're risking yourself there is if you're looking to buy it and flip it quite quickly, and whether there is a continuation of the reduction in property value. If it is buy hold, well, you've got 20% off the original purchase price. Thanks very much.
Okay, so next question, because we've got to round this up very quickly. Insulating pockets. So let's say, okay, everyone thinks it's going to go down. Let's say it does go down. Obviously, like we've seen in 2008 and 9, there are pockets around the UK which are really not, affected that much. So where do you think this time round will be? Do you think they'll be in the same places? Where do you think, let's say there is a crash, where will prices not drop that much or drop at all, would you say?
Norfolk is fucked.
Norfolk is fucked, did you say? Great, that's good.
Thanks for calling me Swedish.
Didn't you mean in Scotland? Simon, I've got an interesting concept which I'd love to bounce off these guys. I get people coming and saying, I want to buy a £500,000 property in London as an investment property. Whereas I challenge people and say, why wouldn't you buy, say, 500 grand properties elsewhere? Because you're spreading the risk over a larger area, but you're also putting less deposits down. If there is a correction on a 100 grand property, a 20% correction or 20% correction on a £500,000 property, that's huge figures. So do the property investors here prefer to invest in bigger properties, or would you spread your risk over, say, 5 smaller properties in this instance?
It depends on what the outcome is, isn't it?
Yeah, and where they are. I generally dislike the argument of go miles and miles away from where you know and live and can operate in and buy X. Because if you go far enough away, you can find whatever you want in whatever budget you have, but it usually doesn't stack up, should I just say?
You would prefer to put a huge amount into one property locally?
If the alternative is to go somewhere I don't understand, or somewhere I don't have an edge in, then yes.
Okay. Would you not wait for something to pop up in your local area though? So do five. If we said you could find properties in your local area, so let's try like a level playing field.
All else being equal, I would take the cheaper properties if they were rental properties.
Because you're spreading it in local area, but different pockets in the local area, different type of properties potentially, opposed to lumping it all into one property.
Absolutely. If you could guarantee all else being equal, then absolutely.
If you're going to hold a property, then you'd go to the highest yielding property almost that you could sort of find within your locality, because you've got the best chance of being able to service debt, and like you say, you're spreading risk. So if a 500 grand property is a cheap one, as in between 1 and 10, if it's at the lower end of the market, then fine, it's going to yield higher than a £2 million property.
No.
But locality is definitely the most important.
Yeah, cool. It's always an interesting conversation with my clients, so I appreciate that. Thanks, Carl.
Okay.
Yeah, but if the £500K property is only spitting out 1% return, whereas the 100K properties are spitting out 25% return, or vice versa. So it depends on what you want.
Yeah. Okay, so we got a minute and a half, or 2 minutes basically, before we need to stop. I want to stop this dead at 2 hours. I'm sure we could chat for hours. So I guess quick recap really. We've covered quite a lot. So as I said at the beginning, it's a wealth generation game. You have players, you have spectators. The game is to become financially independent or financially free if you are wanting to be a player. Don't break the law, and don't be a dick. So spectators, this is what I've said, not the group, for those who jumped in a bit late. Conventional means if you're just going to spectate, buy a house, live in it forever, Warren Buffett style. But if you're a player, there's lots of different things you can do. Aggressive wealth accumulation phase of your life, which is where really you're doing all your property stuff, and then you can do, mind you, a lot of the stuff we've spoken about today actually can also cross over into your capital preservation play. So yeah, we looked at property as a whole. There's quite a lot. So yeah, this is why when people say, Simon, you're really bearish on property, I'm like, well, some parts, but as you can see here, there's so many different things in different silos. In general, I'm just not keen on buy-to-lets at the moment, personally, just because I see house prices crashing. Just me. And as we see, there's lots of different things. We've placed all sorts of different yields on a few things. It seems like the group today loves HMO, service accommodation. Ian quickly said, buy for yield, not for growth in uncertain market always. Employment will have a huge effect on prices over the next 5 years. Yeah, another reason why I just think, yeah, anyway, it's another topic. So service of accommodation looks good. Flipping also looks really good from what we've said. Lars then shared the big or the typical progression. Accidental landlords, hey, this worked, let's do it again, let's scale it up a bit. And then they get into HMOs, then service accommodation, and then developing of all of its various forms. So yeah, that makes perfect sense. And I've seen, in fact, I know loads of people have done that whole route. Then we looked at the average or the spectator suddenly thinking or wanting to become a player. What can they do? Basically, deal sourcing and resi development, it may be really deal sourcing, to get your teeth stuck into it. And really you can't do a JV and be the knowledge or the doer without doing anything first. So I guess you've got to get some, I guess it's a rite of passage doing all of the doing stuff before you can find a money person to scale up a bit. Or property management, but not now, but then deal sourcing, yeah, all that sort of stuff. And COVID, then we've just been chatting. Cool. Well, I think, if anything, from what I think this is something, this picture here, I think a lot of people are completely unaware of, and it's that rising house prices actually hurts the economy because it results in people having less to spend in the economy, and this is the thing. There is a certain amount of a disconnect that between rising house prices and rising income, as in job income, but eventually gets nuts, which is what's been happening over 2008. But due to financial engineering, they could kick the can down the road. A lot of those things cannot be kicked now. They've already expunged all of those. Some of the weapons, like dropping rates to zero, they can't do that anymore. And so a lot of these measures are like big old heroin or morphine kicks. But eventually that rubber band or that acceptable gap will snap back. History has dictated or shown us quite clearly that this always snaps back. Not necessarily, sometimes it overshoots, sometimes it just resumes normal course. But I think it would be naive to ignore history. And then so I just really want to thank you all. Thanks. It's been riveting for me. I don't know about you guys. So yeah, hopefully someone's learned one new nugget. I have. Have you guys?
It's been good.
Yeah, it's been brilliant.
Always nice to talk with other property people.
Yeah,
definitely.
Yeah, it's good.
Cool. Right, I think we should do a similar one for crypto next. Okay, well, I'm going to end it there. Thank you so much. I will, for the realistic traders and the whappers here, you will have access to the recording. Don't worry about that. And I'll see you all soon. Toodles.
Thanks a lot. Bye.
Cheerio.
Bye.
Bye-bye.
Thanks, guys.
Thanks, guys. Cheers. Bye-bye.